Hey everyone, welcome back to Corporate Decoder, the place where we make sense of the financial jargon so you don't have to. And get ready because today we are diving into Fortis Inc's mid-year update, and let me tell you, there are some interesting numbers here. This report is basically a check-in on how Fortis Inc has been doing financially up to June 30th of 2025. They file these reports to keep investors and the public informed about their financial health and what they're up to. It's like a mid-year financial report card. Remember to subscribe if you like getting these straightforward breakdowns and join our Discord community linked in the description below. Fortis is a big player in North America and around the world when it comes to utilities, electricity and gas. They own and operate a bunch of different energy companies in Canada, the US and the Caribbean. Think of them as the folks who keep the lights on and your home heated through a wide network of different companies they manage. This specific filing is a Form 40F, which is for certain Canadian companies to report to the US Securities and Exchange Commission. It mainly refers to other documents that contain the detailed financial information like their unaudited financial statements and management's discussion and analysis. So while this document itself is brief, it points us to the juicy details. Let's get right to the heart of it by looking at their unaudited, condensed, consolidated, interim financial statements as at and for the 6 months ended June 30, 2025. This is where we see the actual numbers that tell the story of Fortis's performance in the first half of this year. Looking at the equity section, we see figures related to common stock and other equity components. These represent ownership stakes in the company and how the company's earnings are distributed among shareholders. For instance, the numbers here for common stock give us an idea of the capital raised by issuing shares. Retained earnings are the profits the company has kept over time, rather than distributing them to shareholders. A growing retained earnings figure generally suggests the company is profitable and reinvesting in its business, which is a positive sign for long-term growth. Non-controlling interest reflects the portion of equity of subsidiaries that is not attributable to the parent company, Fortis Inc. This often comes up when a company owns a majority but not all of another company. It's important to understand this as it gives a fuller picture of the overall financial performance of the consolidated entity. Fortis breaks down its operations into different segments, mainly regulated and unregulated operations. This helps us understand where their revenue and profits are coming from. For example, we see here mentions of specific subsidiaries like IT Holdings Corp and Central Hudson Gas and Electric Corporation, indicating those are key parts of their regulated operations. Regulated operations are typically utilities where prices and operations are overseen by government bodies. This often leads to more stable, predictable earnings because they are essential services. We see a lot of activity here with mentions scattered across different entities like UN Energy Corporation and Fortis Alberta Inc. Unregulated operations, on the other hand, are more market-driven and can offer higher growth potential, but also come with more risk. This segment includes things like corporate and other operations and inter-segment eliminations, which are just accounting adjustments between different parts of the company. This specific line captures accounts that are used to stabilize rates for customers or account for special regulatory items. Seeing these accounts change over time can tell us about how regulatory decisions are impacting the company's financials and customer pricing. Here we're looking at how much money Fortis has borrowed through long-term credit facilities. Debt is a normal part of financing for large companies, but it's crucial to see how much and how they are managing it. The line of credit figures show the amount of credit available to the company. Whether they are using it or if it's just available shows their short-term financial flexibility. This entry details specific debt issuances like unsecured senior notes. The maturity date 2055 tells us this is a very long-term debt. Understanding these details helps us assess the company's borrowing costs and maturity schedule. Another long-term debt instrument here, specifically debentures. The inclusion of subsequent event members suggests that some of these financial activities might have occurred just after the reporting period, showing the company's ongoing financial actions. This line item relates to the company's obligations to its employees for pensions and other retirement benefits. Managing these long-term liabilities is a key part of financial stability for any large employer. Derivatives are financial contracts whose value is derived from underlying assets like energy prices. Fortis uses these to manage risks associated with fluctuating energy markets. Understanding if these are subject to regulatory deferral helps us see how these risks are being managed financially. When derivatives are subject to regulatory deferral, it means the costs or benefits associated with them can be passed on to customers or recovered over time through regulated rates. This can smooth out earnings volatility caused by market swings. This section delves into how Fortis values certain assets and liabilities on a recurring basis. This includes looking at level 1 or level 2 inputs, which essentially means if their value is based on readily available market prices or more complex models. This highlights their use of financial instruments to manage currency exchange rate risks and the performance of underlying assets. Companies operating internationally like Fortis use these extensively to protect their profits from currency fluctuations. This is an interesting point about customer concentration risk. When a company has very few customers that contribute a large portion of its revenue, it creates a risk if one of those major customers is lost. This refers to using financial instruments to protect the value of investments made in foreign subsidiaries against currency fluctuations. It's a sophisticated way to manage international financial risks. Companies are often required to disclose the carrying amount, which is the book value of an asset on their balance sheet, and then compare it to its fair value, the amount it could be sold for. Significant differences can indicate potential issues or opportunities. This mention refers to one of their operating companies, US Electric Inc., and highlights their use of an engineering, procurement, and construction agreement. This likely relates to a project development or major infrastructure investment. Preferred stock is another type of equity that has priority over common stock, but usually doesn't come with voting rights. The mention of specific series like Series H suggests different classes of preferred stock, perhaps issued at different times or with different terms. This is about their defined benefit pension plans. These plans promise a specific monthly income to retirees based on factors like salary and years of service. Managing these obligations is a significant long-term financial commitment for companies. Another subsidiary mentioned UNS Energy Corporation, pointing to the diverse range of operations Fortis manages. This is the flip side of the regulatory deferral point. Derivatives not subject to deferral mean the gains and losses from these are recognized directly in earnings and aren't passed on through regulated rates. A total return swap is an agreement where one party pays the total return of a specified reference asset in exchange for a fixed or floating rate payment from the other party. It's a way to get exposure to an asset without owning it directly. These are contracts used to hedge against fluctuations in currency exchange rates. For a company with international operations like Fortis, this is a critical tool for financial risk management. An interest rate swap is an agreement to exchange interest rate cash flows, typically between fixed and floating rates. This helps companies manage the risk of rising interest rates on their borrowing costs. This again highlights specific long-term debt obligations with a maturity in 2029. These contracts are used to manage both currency risk and interest rate risk simultaneously when borrowing or investing in different currencies. These are specific contracts related to electricity prices, where the financial impact can be managed through regulatory channels. This demonstrates how they are trying to stabilize their earnings from energy market volatility. Similar to electricity contracts, these are for natural gas and show how regulatory mechanisms are used to manage the financial aspects of a gas supply, ensuring more predictable costs and revenues. These are agreements for buying and selling energy commodities in wholesale markets, but the financial outcomes are not directly regulated or deferred. This means their profits and losses here can fluctuate more with market conditions. This reiterates the point about having too few major customers. If many of those customers are concentrated in one segment, it elevates the risk if that segment faces any downturn. For Fortis, who have a diversified portfolio of businesses, this is particularly important to monitor. This relates to financial strategies used to protect the value of their investments in foreign countries from currency swings. It's a way to ensure that when they convert profits back home, the amount doesn't get hit hard by exchange rate changes. This is about the fair value of their financial instruments. Essentially, it's asking if the price the company has on its books for these investments is close to what they could sell them for today. Now looking at the overall picture for Fortis in the first half of 2025, things seem to be progressing as expected for a large utility company. Their approach of managing diverse regulated and unregulated businesses gives them a degree of stability. The heavy use of derivatives and hedging instruments, while complex, shows a proactive strategy to manage market risks, which is crucial in the energy sector. What stands out to me is their extensive use of long-term debt and various financing instruments. While this is typical for capital-intensive industries like utilities, it means they have significant obligations to manage. The mentions of specific debt issuances and credit facilities highlight their continuous need for capital and their strategies to secure it. A key risk for them remains regulatory changes. As a utility company, their earnings are heavily reliant on favourable regulatory decisions. Any adverse rulings could impact their profitability significantly. On the flip side, their diversified operations across different geographies and types of utilities like electricity and gas provide some resilience against localised economic downturns or regulatory issues. Overall, Fortis appears to be navigating the current financial landscape by leveraging its diversified asset base and employing robust risk management strategies. While the debt load is substantial, their consistent investment in essential infrastructure suggests a stable, if not spectacular, growth path. The focus on regulating energy contracts and derivatives indicates a sophisticated approach to managing the volatile energy markets and ensuring financial predictability. Alright, that's our breakdown of Fortis Inc.'s mid-year financial check-in. What's your take on their strategy and these numbers? Do they inspire confidence or raise concerns for you? Drop your thoughts in the comments below. If you found this analysis helpful, make sure to hit that like button. It really goes a long way. And of course, subscribe to Corporate Decoder for more in-depth looks into company filings. Don't forget to check out our Discord channel linked in the description for more discussions and insights. Thanks for watching and see you next time.